Good afternoon, welcome to the Cycle for Entrepreneurs, a 10-session program that addresses all aspects of entrepreneurship. Take this opportunity to extend a cordial greeting to all those who are joining us for the first time, and especially to those who are seeing this cycle from different parts of the world. As you know, the Cycle for Entrepreneurs is an initiative promoted by the Alumni Association, a new project of the school that offers 5 large areas of service to students: an alumni in training and knowledge, professional development, networking, benefits, and discounts. Show Me the Money Startup Funding is the 9th module of the cycle and will focus on the different techniques and phases for startup funding, as well as the most used investment models: business angel, venture capital, and private equity. To talk about this topic, we have the presence of Álvaro Cuesta. Álvaro is the co-founder of Sonar Ventures, the first Spanish startup producer. It is a company that is dedicated to advise, accompany, and launch new projects of proven success in the international field. Álvaro is also a consultant and exporter in different companies and institutions in topics of digital strategy and entrepreneurship. Also, he was the president of the Young Entrepreneurs Association of Madrid and the Young Consul CEIM. Before giving the word to Álvaro, I invite you to participate in this session and ask your questions through Twitter using the hashtags that appears on your screens. Again, welcome.
Well, thank you very much for the introduction, and thank all of you for being there one more time, and from all over the world, different parts of the world. For the people that are actually listening at this specific moment and in the live session, and also for the people that will be listening in the future, and also in the podcasts that I've been aware that there are some podcasts out there that have these sessions. So today we're going to talk about startup funding. We're going to talk about Show Me the Money. As you remember that Jerry Maguire quote. It's like, show me the money. Well, this is in the end. We need money to accomplish our projects, and one of the main KPIs of our success is the money that we make. Of course, is not the only one, and that's for sure. Just to put in context, as you mentioned, this is the 9th session, and I'd just like to summarize the previous 8 sessions, just to put in context. Okay. As you know, this is one seminar about how to build a successful startup. Now, success, we've always mentioned that it's not just about the profits that we make, or how if we make an exit, we sell the company, we become rich. Of course, this is one of the possible outcomes, and of course, it's a very good indicator of success. But we mentioned, and when we talk about how to launch a successful startup, is about basically doing it for the right purpose, with the right people, with the right methodologies. So at least we know that we're minimizing the risks of the high risks of the failure of that company, and having fun in the meantime. Of course, being aware that this is a very, very complicated task of being an entrepreneur. So to do so, we've covered all the different aspects. We've seen how important was to start from the why, you remember the golden circle, the why, how, what, to have a purpose on our entrepreneurial project, because otherwise, when things get tough, and they certainly will, we will have to look inside ourselves and see if we are motivated enough to continue, because at that point the money will not be a motivation. Quite the contrary, it will be a demotivation, because we will not have the money. So it's very important to keep that in mind, to have that purpose clear, and to start from there. Then we've seen the how, the methodologies that will help us along the way to lower the risks. We've seen the customer discovery, customer development approach, the lean startup approach, how the scientific method helps us to at least measure and be aware of everything we do, and measure it, and therefore keep assuming different guesses, different hypotheses, running different experiments, and according to the results, just see if we are on the right track and iterate or pivot if we think we need a major shift in our business model. We've also talked about the who, the team, not just the team, even ourselves. What are the main traits, the skill set that we need as entrepreneurs? How emotionally intelligent we need to be? What are the main, we've talked about how important resilience was, the perseverance, one of the main, of course, they are all important, we know that, but specifically, people that persevere and that become resilient as entrepreneurs are actually the most successful ones. Resilience and perseverance also comes from passion. That's why it's very important to start with from the why. And then once we know who we are, what are our main weaknesses and strengths, then we shall look for the other people that complement us, and therefore we should use the different archetypes just to see if we are a hacker, a hustler, or a hipster, as we've seen as well. A person that pays attention to design, the product, the details, the aesthetics and the emotions of the product, or is more focused on sales and people and communication and enthusiasm and social approach, or operations, processes and KPIs and more of a realistic approach. Of course, we all have a little bit of everything, and that's healthy, but we should know and should be aware our main trait, and therefore look for people that are not just like us, but actually complement the team, and therefore start building the team on top of those traits and start scaling. Speaking of scaling, we've discussed as well about the operations in the startup and how important was not just to pay attention to operations when we grow, but actually start paying attention to operations in a startup at the very beginning, because we've discussed about the fact that a startup is a small company, a small organization, temporary organization in constant search of a business model, but at the same time very scalable in time thanks to technology. But also operations need to go according to that scaling. Otherwise, we will die, not because we don't make money, we don't make users, but we don't scale at the rate that we should scale. So we've discussed about operations, about team, about purpose, about customer discovery, customer development. We've discussed about how important the culture was. You remember the book that we mentioned, Culture Eats Strategy for Breakfast. It's not about the methodology, it's not just getting the best players on the field, it's about having a very powerful team, and that it's only through a very strong culture. And therefore, from that culture, we will have powerful operations, and we will do the right fundraising because we'll attract the right talent, and therefore we'll have more chances of becoming successful. Then we've discussed about growth. Of course, none of this would make sense if we don't have paying customers, or at least users that actually enjoy the product or the service that we offer, and therefore we solve a specific problem. You remember the different stages that we've seen with these methodologies of customer development. It's about the problem solution fit, and then the product market fit. Once we reach the product market fit, then we should look for traction. That's when we have to scale. And that traction, it's only thanks to the different methodologies that will help us grow our customer base. And for that, we've learned Metrics for Pirates. Metrics for Pirates is a framework from Dave McClure that will help us to apply this R, this actual expression of the pirates where they're going to attack, that actually stands for acquisition, activation, retention, revenue, and referral. Don't forget that, keep that in mind, that framework: acquisition, activation, revenue, retention, referral. Now, with all that and the technological aspects that we've seen in the previous session, we've seen that how important was the front end, the back end, how to choose the right product manager, the right product owner, the right CTO, when is the right time to choose the right technology stack, or just start from an MVP, a minimum viable product, and then move from there. and so on. So we also paid attention to technology. So I just summarized eight sessions in 5 minutes or 7 minutes.
Yep.
So I'm sorry if I just condensed it too much, but at least if you've seen all of them, you will have a very good view of those. And if you haven't, at least you put it in context, and it's a teaser for you to watch it. Okay, so pay attention. They are on YouTube. You can find them there. Okay, now none of this would be possible either if we didn't have funding. We need funding. Now, we might need more or less funding depending on the type of entrepreneurship or the company that we want to build, or the type of entrepreneurs that we are, or many other aspects. But we will see today how and how much and where and from whom to get the funding that we need for the startups that we found at the right stage. Okay? And in order to do so, we're going to identify the different stages, and we're going to try to answer to the most common questions that arise to entrepreneurs most of the time as we move on. How to do the right valuation, how to, how much money should we ask at certain stages, and what is the percentage that we should ask for in exchange for it, and many other aspects that we will see in the next hour. Okay, now I need to, find the slides. It was Esse Actos 2017, I think it was. There you go. So that's the main topics that we're going to cover, the guidelines. Why fundraising? Why is it important to do the fundraising? What are the different funding stages in a startup? And very important, what are the different types of investors? Because it's it's not the same when you pitch, when you try to get funding from a friend or family, or from a business angel, so-called, or from a venture capital. Not to mention a private equity that honestly I haven't been involved with any until this point. So no company has bought mine for 300 million. So I cannot tell you my experience with it. But I've dealt with the other types of investors, and what I want to exchange here is also not just the theory that you can find elsewhere, but also the experience and the mistakes, the common mistakes that I've made along the way. So that's another topic, the types of investors. Other topic is about startup valuation, as we mentioned, and then we will see the different investment vehicles that you can find to get money for our company. Now, stages. Probably most of you that are listening will be in the seed stage or the idea stage at this point, and it's very important to take that into account. You need to be aware that your cap table, the whole percentage of all the shares that you own in the company, is a very, very, very valuable asset that you need to become the keeper of that cap table as one of the main resources that you have as a company, because that cap table is what captivates the value of the company, and it should be and it's the only thing that you have in exchange for the money that you will get along the way, not just from the investors, but also even from your employees. So don't forget that, and actually it's not included in the guidelines of the presentation, but I'd like to give a small just a small words on it, a few words on it, because it's very important. We should not only consider fundraising from investors, like in cash, but we should also pay attention to fundraising in equity in shares. It could be stock options or phantom shares or other things, I will tell you, with our own teammates. Okay, and as I was saying, it's something that we'll have to keep throughout the whole life of a company. So if we give away all the shares or the ownership of the company in the first round just because we think we need the money, and this person comes and has like a 50k to invest in our company, and we're willing to give 30% of the company in exchange, we need to be aware that probably if we need to grow and scale, we will need at least 3-4 more funding rounds, and other investors will ask for more money and will give you more money and will ask for shares in exchange, and therefore it might get to a point where you lose ownership of your own company. And that is not the first time I've seen one of the companies going on bankruptcy and failing just because the CEO lost complete ownership of the company. So no other investors wanted to put money on the company because the risk was too high, because the company was not in hands of the entrepreneur, but was in the hands of the entrepreneur and other investors that probably didn't trust or had other intentions or whatever. So very important to know the whole roadmap of the fundraising of the company, how and what to give in exchange for that money that we need at the different stages. So don't ask for too much, don't ask for too little, and don't give away too much, and don't give away too little. I know it's not easy, but in the end, it's the way it's done, and most entrepreneurs end up doing it. So don't be scared about it either. Okay, and not only about valuation, is the main topic, but also about regulation, because when we deal with fundraising, we should not just pay attention on how much percentage we give away, but also on what conditions. It's I've seen companies, like even yesterday, I had a friend. He asked me to take a look at his shareholders agreement, and it was funny because he was willing to sign it, and he was just like, "Hey, this is the shareholders agreement," and it was terrible. He was signing his own death sentence because he was about to sign what it's called a drag along clause, which is very common. I mean, most shareholders agreements have it. But he was willing to sign a drag along clause that, for example, if within the next 3 years anyone, not him, wanted to sell the company, and the company was and the valuation that company was that the buyer was willing to pay was higher than 1 million, the entrepreneur would be forced to sell. So that, which is a common clause, but what is not common is the valuation of 1 million, okay? Because in 3 years, the valuation of your company will certainly be higher than 1 million. Otherwise, you got a problem, okay? Of scalability or growth. So imagine you do all this effort, you do all the steps that we've covered in the previous sessions, you raise funds, you get investors on board, and you sign just a small document that the investor is sending you with a shareholders agreement that he or she wants to sign, and then you lose your company because that person needs to get some cash because whatever, wants to do another investment, doesn't trust your project anymore, or just wants to have quick cash. He invested at a valuation, let's say, of 300k, and has a friend that can buy the company for 1.2 million. And the company is already probably worth 3 million. Or probably is even 1.2 million, but you want to make it much bigger. Imagine he or she has the 10% of the company. Even so, with the drag along clause, you would be forced to sell. Maybe you might think this is a technicality that we should not even discuss, but honestly, this is more common than you think. Shareholders agreement is something that you should pay attention specifically, and actually we should have a full session on shareholders agreement because it's critical to regulate the relationship between the partners and co-founders, and also with the different investors that come along the way. Other clause that he was about to sign was what is called a liquidation preference. Now, liquidation preference is, let's say that this person invested 50K for 20% of the company. Okay. Now, if a new buyer comes with the company, and that person has already 10% of the company because of the different stages that they've gone through, the buyer, imagine someone buys the company for, let's say, 500K. Well, then the different shareholders would have the right to get not the percentage they have of the company, of that amount, but the whole money that they invested. And when all the investors got all the money that they invested, then you get your money. Which is also a very common clause that some investors try to include. And you should pay attention to that. Because I've seen people selling their companies, and because of that liquidation preference, all the investors got their money first, and there was no left for the entrepreneur. So it was a very bad decision to sign that liquidation preference. Okay. By the way, you can ask me all kinds of questions. You can interrupt me. You can make comments at all times, because I'm sure it will be much interesting for all the people that are listening to us. Okay. So, as we were mentioning, it's not about evaluations. It's about also finding the right people and also find the right regulations. Shareholders Agreement. Now, when we were discussing about preserving our cap table, just be aware of the stage that you are, and if you are at a very, very early stage, let's say you need 10,000-15,000 euros to start with your minimum viable product, then don't even go to business angels, don't even go to professional investors. Just try to raise that money from your friends, what they call the 3Fs traditionally. They call it the friends, family, and fools. Well, try to avoid family and try to avoid fools, okay? And you might say, well, what about friends? Try to avoid close friends. That's my advice. Not because you're trying to scam or because you're doing anything wrong by fundraising, but the risk is so high and people tend to mix emotions with business. Just try to have them, just to try not to mix. But at the same time, sometimes at the very beginning, people, when you start a business, they only trust on you personally, not even in the project, because there's nothing but a small minimum viable product and just a few experiments and nothing more, and barely an idea, So so just try to find, people you've worked with, old bosses, old workmates, people that they trust you, but they're not childhood friends. Okay, it's funny because my childhood friends, they only invested. I think the first time my childhood friend invested, or I asked him to invest, was it was last year, like 8 months ago. I'm 37. I've been building companies since I'm 18 or 19 years old, and it's the only and first time I asked him to invest some money and making very much sure that he needs to be aware that the money is already lost. I mean, that the risk is way too high and that you never know what's gonna happen, and it's not my fault if something goes wrong and our friendship prevails. So imagine if I waited so many years and I've been through a lot of stuff, a lot of hard problems where I could have called them and still asked them for money. But I think that's a more valuable asset if you have them as friends, because those friends are also part of your assets when you need to walk and go along the way and have the emotional support. So don't burn that or don't use that bullet. Just try to use this type of friends. Don't try either at the very beginning. We're talking about the pre-seed stage. Don't try either to go to the banks. That's another hint that I would take into account. The risk is way too high. I mean, your chances of success when you start, they're less than 1%, honestly. I know it sounds pessimistic, but I try to be realistic. So would you actually ask for a loan, even though you feel passionate about your project and everything? Would you ask for a loan for a company that has 99% of chances to fail? And would you put your personal money and your personal assets or your family's assets as a warranty to support that in case the business doesn't go well? It doesn't seem like a very smart choice. So try to avoid that, because I've seen that also happening many times. I've done it myself a few times, just once, at the time where that was more common, because there was not such an ecosystem of startup investors in Spain. And so what I would recommend you is probably to go for what they call soft loans. That could be okay, where you don't have to give a warranty. You can actually borrow money from the bank, but if the business doesn't go well, you're not putting your house or your future incomes on the table, because that's way too risky. Not to mention your families. Okay, I've learned that the hard way. Believe me. I even made a bigger mistake. There was it was not actually. It was my mistake, but it also was my partner's mistake. Let me tell you a small anecdote. We asked for a loan that we had a warranty, that it was a public warranty, but at that time, that institution that was called Aval Madrid, they asked all the partners to sign a personal loan in case the loan was not returned. We did, in good faith. And the problem is that the way we signed that document, we would respond with our future assets. Okay? We were over optimistic at that time, and we just thought, okay, we'll ask for this loan and we'll just give it back. It was like 40,000, 60K, sorry. What happened is that the crisis came, Lehman Brothers, all these financial storms, and we couldn't return the loan. And I couldn't personally return it. And one of the small partners that actually had 1% of the company, and it was a small investor, it was the only one that didn't sign the warrant with a different, let's say, investment vehicle, and she signed it personally. And therefore the bank went after her, and she just had a house, and they wanted to take our house for the whole money, and she only had 2% of the company. So imagine how guilty I felt, how pissed she felt for her own decision, but in a way she felt pissed about it. So in the end, of course, the end of the story is I managed to sell other shares from other companies to pay her so that she would not have to face that situation. But imagine if I hadn't done that, she would have lost her whole house because she signed an agreement where she was giving warranty for a loan and a business that, at that point actually was very, very apparently was going to work, but finally didn't. So don't do bank loans, and if you do, don't sign with your own assets. And if you do sign with your own assets, just do it when the business is very mature. Otherwise, don't take that risk. It's not worth it, honestly. And especially don't put people on that situation either. Okay.
And someone you can go over the agreement,
exactly,
check everything's okay.
Yeah, always have a good lawyer, by the way.
Yeah. For everything.
Absolutely. It seems like it's something that you might not want to use because you have other urgent expenses at that time. So lawyers appear to be expensive. I am a lawyer myself, and trust me, is to see it as an investment. Good share. If you consider, out of my first 10 minutes of the webinar, I've discussed about shareholders agreement and an agreement for a bank account. So, just food for thought. It might be important to check the agreements because you might do all the things well, but if you don't do your homework from a legal perspective, you can be dead. Okay, so take that into account. Now, let's assume that we are at this stage. We've already covered 10, 15K. It's like, okay, yes, but what do I offer? What do I offer to my friends, my colleagues? What do I give in exchange when I say, hey, I have this wonderful opportunity? First of all, don't go for fundraising with a PowerPoint. It's the worst thing you can do. You can always, if you do what we've covered in the previous sessions, you have to build an MVP. No matter what you do, just do an MVP. Okay? Do an experiment. Do something specific, even if it's a landing page, a video teaser showing what your product is about. Even if it's a restaurant, whatever, just try to rent a few weeks a specific place and try to give some KPIs about key performance indicators about what you want to sell. Otherwise, just don't go funding with an idea. It's the worst thing, because in the internet days, building a minimum viable product it's almost for free, honestly. There are tools that will help you to do it for less than $1,000 or euros. So if you haven't been able to put at least 1, 2, 3, 5,000 euros on the line before you ask others to invest it, I will not invest myself. And with that, it will give much more added value. You will have some results to give that will convince the investor, even if it's not a professional investor. At least you're selling something tangible. Okay. So before going for the first round per se, just do what they call bootstrapping, which is finance with your own resources. And just do so until it's completely necessary to go for funding. Okay. Trust me, most entrepreneurs don't do that. They ask for funding before starting the business, and they end up not doing the funding, or just getting the funding but spending it on experiments that they should have done in the first place, but with the money of the investors, and then they run out of cash and there's no other funding round because they've already consumed the money that they got from the investors. So use your own resources as much as possible. Okay. Investors will value that a lot. Okay, one of the things that investors value the most, from my experience, for example, I had one funding round last year of one of the companies at Sonar Ventures, Food in the Box. It was a 100K round, and one of the investors was the former treasurer of the Banco Santander. So imagine, former global treasurer, like one of the big fish in terms of investors, right? This person, apart from the fact that he liked the idea, he liked the team, what he appreciated the most is when he saw what we did with the previous round and what we accomplished with the previous round, because it's a good indicator of what you are going to do with his money. And what they value is, it's not just if you're a good professional, but if you really take serious that their money needs to be spent very carefully and very insightfully. So everything you can avoid to do with their money and that you can do with your own money, go for it. Okay? And just make the most out of every single euro, because investors will really appreciate it, believe me. I know when you work in a corporation, it's not your money, it's your budget, is your department's budget. So in a way, you don't take it as serious. So you're more used. I've seen entrepreneurs that come from big corporations that use the money as as if it was the other company's budget because they didn't invest it. Okay, just try to avoid that. Believe me, I had companies where I've seen the opposite of what I just told you. I've been a partner of companies. They came from big corporations, like big consultancy firms. I'm not going to mention, like huge, like top one consulting firm of the world, and they raised with me a funding round of 300K. They spend it like that, and well, they ran out of money because they didn't pay attention to each and every cent, and they couldn't make it to the next round. So we had to sell the company, which was a success in itself, but in the end we could have sold it for much more money and create much more value. We sold it because we needed to sell it, not because it was an incredible opportunity. So we didn't pay attention to each and every cent, and it was a big problem. So once again, it's not. I know that on the other side, you should not be scared of money, if I may say, because I just remember one conversation that I had with this person. It was a former partner of this top one firm in the world. Actually, he's the country manager of Amazon in one of the companies at this point, in one of the countries in the world. And I asked him, what makes a difference between this elite that you're supposed to be considered and the rest of us? And he said, we're not scared of money. We're used to talk about millions and millions as nothing, we don't care. And at that point was like, wow, I should learn from this guy. 6 months later, we had to sell that company because he was not afraid of money. So the wisdom that applies for corporations not necessarily is applied for startups. Okay, just good to know. So valuation. Normally, about valuation we will discuss later as in different stages. But I think maybe it's a good time now to speak about it. How much do I value my company, and what are the different methodologies to value the company? Well, if you use the traditional methods, you are going to come up with numbers and amounts that are crazy and out of market. Okay? When you want to value the company, there are different traditional methods like DCF, discount cash flow. I don't know how many people are from the people that are listening are coming from the financial background, but you have the venture capital model or the discount cash flow model or the Monte Carlo model. You got different ways to value a company. The reality of the investment ecosystem is that it's more about supply and demand. It's more about how much money are you willing, how much money do you need in that round, how much money is the investor willing to give, and how much equity are you willing to give in return, so that you can accomplish the other stages that you have ahead of you without losing ownership of the company. And in the end, I know it sounds unprofessional or asystematic, but trust me, at least until venture capital stage is the way it's done. Okay, let's put it this way: when you start a startup, I haven't seen. Most valuations with an MVP, not a team yet, just an idea and some products made, very few KPIs, just a few months along the way, no more than 100K valuation. So you might give away 10% of the company, not even 5% of the company, for 15K, 20K. Okay, you can justify that financially speaking. It's very difficult. How are you going to do it? You have no track record. You have no data to justify. Your projections are based on nothing, because you still need to do and run so many experiments about your own business model that you still don't even know how much you're going to grow. So you cannot project that, or you can do it, but still it's not accurate. So I think it's better to say there's a rule of thumb per se, and my advice is never get a dilution of your company of more than 25% that's for sure. Let's say never give up more than 25% of the company in a funding round. That's first thing you should take into account. Most of the time, just go between 15 and 20%. That's the average. And normally, when you start with your friends, family, and fools, normal amounts of money are between 50k, okay, just to have let's say 12 to 15 months of runway, so that the company can be alive, and then go to the next round. So when you go for the next round, you might need to go the average. Of course, each company is different. Okay, when you go to the next round, you might need another 15 to 18 months of runway, and therefore, but your costs will be higher because you will already have a team, you already have a technology, you will already have to invest in growth or marketing. So what you need to take into account is, how much do I need? And for that, normally it's good to take into account the next 15 to 18 months. Don't ask for money for 6 months, because it doesn't make sense. Otherwise, because you're closing a funding round and you will have to start raising again 3 months later. And in the best case scenario, you will close the round 3 months later and you will be almost dead and then get into the next round. So it doesn't make sense. It's better to ask enough money to cover your expenses for the next 15 to 18 months, so that within the 6 months from the previous round, you can start getting in touch with investors. And just consider that the average funding round is about 6 months, 6 to 9 months. That's the average. Okay. So if you don't have enough time, you might have a great product, a great team, a great company, great opportunity, but you will die because you have no funding. You're not making money yet, because we've covered the previous stages. We're not in that stage of becoming sustainable. Most companies, most startups don't become sustainable until the 5th year. Amazon started to make money, like real money, 2 years ago. Before that, it was losing a lot of money. Uber is losing money like hell. Most successful startups are losing money. Deliveroo is losing money. All the big companies are losing money because they're growing, so they're sacrificing financial sustainability to grow exponentially as much as they can, so that they capture the specific opportunity that they have, and there are no other competitors trying to get part of the market. So that's why you need money. You need money first to find your business model, then to get to traction, and then to scale, then to expand. So each funding round has a different purpose, okay? But in each funding round, you need to know where is the next milestone. How much money are you willing to need until you reach to the next milestone? And most of the time, if you consider how much time it takes for you to get the funding, then just always consider 15-18 months of runway. So if your expenses when you start are just yourself and just a freelance and a few things, and you have like a shitty salary because you're a committed entrepreneur and you don't pay yourself at the beginning, because no one wants to be your employer as an investor. They want to pay you for other things, but not for you to have a salary. Okay, that's not what people invest in startups. So consider that, and that might be for 18 months on a very general basis. Of course, I'm overgeneralizing here. That might be between around 50k, 80k, and that you can raise it, like I said, with just friends, family, and fools, and your own money. Okay. Now, what happens for the next stage? Well, most of the time, from my previous experience, the average funding rounds are between 150 and 300K. That's when we are in seed stage or early stage, okay? That depends on also on the country, what they consider. And that normally covers for 18 months of runway as well, but you already have a burn rate. You already have to spend every month around 12K, 15K or so, because you already have 3 people, you already have a CTO, or at least some investment in technology. You already have an office, so you need to pay rent. So normally the order of magnitude of the expenses of an IT company is around so. And therefore, once again, you should go for funding and think, okay, if I need 100K because I need 18 months to reach to the next milestone, okay? And the next milestone is to find my product market fit. I already have a product and a problem solution fit. I already have a team, okay? But now I need to make my company just find the right business model. And for that I need 150K. Okay, then you should not go for venture capital. Not even consider it. Because venture capital, these investment funds, just consider what they do. What they do when they start a funding, an investment fund, what they do is they get around 20 million euros from private investors, family offices, or whatever, and they say, hey, I'm going to make you more money than you would get on the stock market, but in exchange you will have more risk. But it will not be super risky because I will diversify the risk, because I will invest in an average of, let's say, 10 to 20 startups. So let's take 10 startups. Out of the 10 startups, statistically speaking, if I do my job with the right people and with my expertise, with those, for every 10 startups that I will allocate the money in, 8 of them will fail. Maybe 7 of them will fail along the way. 1 or 2 will actually make us recover what they call the management fees and the structures of the fund, which is between 2 and 3% of the actual size of the fund. Let's say 300K, 500K. So you will somehow cover those costs, and maybe one of them will make you make at least more money and recover what you invested, and there will be a home run, just one of those 10 companies that will make you really end up recovering the rest of your investment plus a profitability. So they need to invest, considering that each and every startup that they invest needs to be the one that will give them the home run. That's what will be in their mind. So they will invest 200K, and they expect to get from you at least 2 million. So you will need to multiply times 10 the profit or the valuation at which the company is sold. Okay? That's what they are thinking. That's what they are expecting. So since it's not their own money, it's not about emotions. It's not about supporting entrepreneurship. It's not giving you support because they like you. It's because they want and they need to make money for the investors. So therefore, since they cannot say, oh, we lost money, it's a shame because we trusted the people that behind the team. No, they need to explain their decision on numbers and KPIs. Otherwise, it's very difficult for a venture capital to justify an investment because the risk is very high and it's not their own money. And the motivation is purely financial most of the time. So, if you want to go to a venture capital, it's too early, way too early, because you will need to justify that you have already a product, a team, and you're already making money for enough time to to have traction, which is somehow a sense that the company is growing and the market is big enough and you're the right person and you're ambitious enough not to have a lifestyle business to make money and just grow organically, but just to sell your company within the next 5 years for a lot of money, at least 10 times what they are investing. So keep that into account. Don't go to venture capital when it's too early. You will need a background, you will need a history before, you will need to have everything backed up. So if it's not my friends, if it's not a venture capital, if it's not the banks yet because there's too much risk, where do I go? Well, then that's when we have the business angels, which are the private investors, okay? Those business angels are key in the previous stages of the company. Now, the motivation of a business angel, a professional business angel, is of course financial, is a way to diversify their risks. Normally they invest 5% of the whole assets that they have, and they normally invest between 5 to 10 startups. That's somehow the average, okay? If you don't invest in more than 3-4 startups, then you're not a business angel. You're just a person that invested in a project, but you're not a business angel per se. So what that person is expecting depends on the type of business angels. You need to search what type of business angel you are looking for. This is very important because there will be people that will guide you along the way, and you try to avoid people that will try to make you sign the agreements that I was mentioning before, trick you, or to take advantage of your lack of experience, or there are people with a lot of money but they're like trying to interfere on your daily management. So when it comes to business angels, you need to know if you look for a business angel that just wants to give the money and just wait for your your monthly reports and just go to the shareholders meeting every 3 months and expect to sell eventually. That's one type, like a passive business angel. Or you can look for other type of business angel, that is the person that is already a successful entrepreneur and just wants to use his or her experience to support other entrepreneurs and make money on the way, but doing what he or she knows to do, which is having a network and helping and guiding. That's I would recommend that. Or is a very knowledgeable professional on a very specific field that has a lot of connections and expertise, made a lot of money, is almost retired or about to retire, and just wants to do that as a way to fulfill and make money along the way. Well, the last two are the best ways from my experience. But at the same time, you have others I don't know, in Spain, like Aviedes or others that they don't like to interfere. They're like super professional, but if they invest in you, they will help you to raise funds with other investors, but they will not interfere on your management. But still, it's good to have them on board. Okay, so once again, that depends on you. And what the business angel is looking for is basically, of course, to multiply times 5, 10 the investment, and there's a higher risk for them because the stage is much earlier, but at the same time the returns are higher. So normally in exchange they're higher because there are small amounts, but the valuation is lower. So once again, if we're looking, ideally, gross numbers, we need between 150 and 300K, and we are willing to give away, let's say 20% of our company, then we should be considering a valuation of 1.8 million, for example, or 2 million, or 1.5 million. Between 1.5 and 2 million is the average valuation in that stage that I'm used to see. Okay, we were raising. Let me just give you the last amounts that we've done in our companies. When I started Sonar Ventures, it was It was 300k starting valuation for 40k initial friends valuation. So that was like yeah, I think like 9% of the company so it was like 300k valuation at the very beginning. Then we did a next round on 800k, and then we did a third round of 1.5 million. With Food in the Box, we started Food in the Box with a crowdfunding round. We'll talk about crowdfunding as well. And we had an MVP, just a small website, just a small KPIs, a small team, small idea, but potentially very good, and the entrepreneurs were good. And we did the initial valuation of 300k, and we were asking for 30k in the equity crowdfunding. So we gave away no more than 10% of the company. Okay. Then we did another one at a valuation of 500k, and then 1 million last year, and now it's 2 million. And all the time we ask for 15-20% of the company less, and after 4 rounds you might get 30% of your own company, 40% of your own company, but you still have control because you have much more than the rest of the partners in the cap table. Okay. So just to give you some references. Now, apart from business angels in that stage, you need to be aware that there are other tools. You probably heard of crowdfunding. There are a few platforms on crowdfunding. You need to know that the crowdfunding especially is equity crowdfunding. Otherwise, I will not bother unless you start like a Kickstarter or other platforms, but that's only for like very initial pre-launch ideas and for a very specific type of products. But for most startups, equity crowdfunding works well. In Spain, you can find a few platforms. You can find crowdcube.es, CrowdAngel, the crowdangel.es, fellow funders. You have Bolsa Social for more of a social approach. Sociosinversores.com is another platform. There are a few of them, and what they do is you make a video, you give all your documents of the company, like your pitch deck, your financials. You say how much money you need for what percentage, which is the valuation, and you make a small video explaining the company, and then you try to get small investors. Some of them will be from the platform that already know the platform and they're just looking for new projects, and others are just people that you ask them to invest in your company and just invest small amounts of that in exchange for a small participation. But you don't need to deal with all of them, but the platform, the equity crowdfunding platform, will deal with all the bureaucracy and that and so on, and so the platform normally takes a stake on that or a percentage of the total amount raised. Okay, so that's crowdfunding. I recommend it for most companies, and I think it's a good way. I've seen companies making a lot of money. Raising a lot of money from crowdfunding. For Food in the Box, for example, which was my only experience with crowdfunding as a fundraiser, not as an investor. It was more than the money, which 30k was okay. But thanks to that, we got some partners that are incredibly valuable. We validated the company because some of our customers invested, so somehow it was a way to see if the idea was good, if the customers would be willing to invest. So it was a good way to test the market at the same time, and just to get some communication about the company at the very early stage. So just consider that. Another way to get some funding at those stages could be startup accelerators. Now, about accelerators, I have my own opinion. Okay, I personally don't believe too much on accelerators, but in some cases I've seen that working. Okay, why don't I believe in accelerators? Well, basically their value proposition is we incubate or accelerate you for 6 months, so we give you free office space. Okay, good, but I don't need it. At those stages, I just have my house, coffee shops, public libraries, Starbucks, whatever. I mean, that's not a problem. Co-working spaces, that's not a problem. Oh, I will also find you mentors. I will give you mentorship. Yeah, it's good. But in a way, if you're a good entrepreneur, you should already have connections. And if you don't have them, which is normal, you can find them yourself. I mean, just talk to anyone and just write them. And I mean, you already have the no for an answer. So you should not lose your equity for someone to, find you a mentor. You should do it yourself and find it yourself. Because that mentor could be a potential investor as well. Don't forget this sentence. If you want money, ask for advice. Okay? It's one of the most successful advices someone ever gave me, and my best investors are the ones I never asked them for money in the first place, but I just asked them for help. And then they got so involved with the project and with me, and they decided to, put money on the table. So, free space, mentorship. Oh, they teach you lean startup. Well, I do too, and it's for free. So, just Google lean startup, Eric Ries in YouTube. You will find thousands of videos about it. It will be, Eric Ries, the owner, the author of the book, is giving so many free conferences on that. Steve Blank, others. I think teaching and learning should not be never in exchange for equity. Okay, and then they will connect you with investors. Okay, fair enough. You need connections. From my experience, these demo days that people talk about, where you pitch and everything, that's normally not how things go. People, professional investors, business angels, don't go to these demo days and see as if it was a Operación Triunfo, like if it was a talent show, and wait to see who is giving the best presentation.
Shark Tank.
Yeah, Shark Tank. It doesn't work like that.
That's TV.
Yeah, this is not a show, and the best opportunities for investors come from a referral from other investors or from other invested companies that they give a recommendation or a referral. That's 90% of the cases. Others is because you actually approach them as it's like, hey, I've heard you're a business angel on this field, so do your homework and qualify the business angels you really want to target, and say, hey, would you have some time to meet and I can show you and talk about this project and whatever. And they're professionals. They look for you. It's their job. So they're not giving you a favor. They should be happy to meet with you if you think you have a great opportunity with you. So, and most of them, they even go to visit your offices because it's the best way they have to get a sense of the company and who you are and the team and how you manage and how you are as a leader and all that, and if you're bullshitting or not when you say we got 5 people in the presentation and then it's all like friends that just put the pictures there, or you got there's a lot of bullshit and excuse the expression on that field, and investors know it, they smell it when you put a bunch of logos of partners, partners is when you just want to put a logo because you started negotiations with, but they haven't paid us a euro to your company. So the more logos a company has in a presentation deck, the less successful the company is, or at least the less money is making. Okay, when they growing, they put their users and their money, and if they don't put their users and the money they're making, it's because they need to put the logos, because it's the only thing they seem to be tangible. So just try to be honest and don't bullshit the investors, because it's their job to find it. Okay. So once again, accelerators are okay, but just the top accelerators, because some investors, they see accelerators as a filter for their deal flow. They find, at least they've done a job of filtering thousands of projects and choosing the right ones, and then present those projects. So if you go for an accelerator, go to one of the top 2 or 3, and that's it. Never give away equity if you're not sure that this is a top accelerator. And there are very few, I mean, no more than 3 in Spain that do so. Okay. And corporate accelerators. It's another controversial topic, but I would not really pay attention to corporate accelerators. Honestly, I believe in corporate venture builders, because I build those in Sonar Ventures, but because I believe that companies should build their own startups rather than accelerating other startups, because in the end, if you get a corporation as a partner, you're already limited by that corporation, and starting a company with a corporation in your cap table, unless it's a very strategical partnership, and you have to be aware that you will sell your company to that corporation, but being aware that you cannot sell it to anyone else, or it will be difficult to sell it to anyone else, because they will assume that if they haven't bought it, it has to be for a reason, because I'm sure they have specific rights to buy it for less money than the market. And a competitor says that, hey, if Iberia hasn't bought the company that they are participating, why should I buy it? When they have all the information and they haven't bought it, why are they allowing me to buy it? Yeah. So it's a problem of incentives there. Okay, it can work, but it's some specific situations and at more mature stages. Foot in the box, for example. Right now, we're looking for industrial investors, but that's a different matter. Okay, we're willing to sell that to that company. We've seen our competitors in the United States being participated by, Campbell's Soup corporate fund, 35 million. Fair enough. For 35 million, I can be invested, but not for 6 months of mentorship. Okay, that's not worth it. Okay, so that's on that stage. As you know, there are a few risks to consider in terms of the methodologies, as we've mentioned. One of them is that traditional valuation methods are not useful. So once again, I'm not saying use a rule of thumb, but integrate different methods, and you will realize that most of the times the valuation is basically the amount you need for 20% of the company, and depending on how mature and how sexy you are as an entrepreneur and as a company, you will be willing to ask for 25% or 15%. But it depends on how sexy the trend is. For example, I'm a meal kit company. I used to be sexy as a sector maybe a year ago. Now the new trend is big data, for example. Okay, because one of my competitors in the United States, they went public, but they lost 30% valuation. So I'm not so sexy in those terms. But at the same time, 2 weeks ago, I became sexier because Carrefour bought one of my competitors in France for 30 million, so that it's hitting up the market again, and you know, so my valuation went higher. So, and because in the end, it's also about supply and demand. You know, if I have investors willing to pay, willing to invest 100K at a 2 million valuation, or if they're willing to invest 100K at a 3 million valuation, then the valuation is 3 million. Now be careful, because this is not about trying to raise in as much money as possible at the bigger valuation possible, because that can backfire, that can go back, that can affect you. Why? And I've seen that happening as well. Imagine I managed to go from a 2 million valuation, that is my current valuation at this point, and I talk to an investor and say, no, now we're worth it 3 million. Okay, I might fool it, or I might even convince, because it makes sense. What happens when I go to a venture capital next year? They will not care about the sector, the trends, the whatever. They will pay attention to my cash flow and my clients and my analytics and my cohorts, and it will be a much more quantitative analysis rather than a qualitative analysis that is done in the previous stages. And maybe no venture capital will be able to invest at more than 3 million valuation. So what happens if I close a round at 3 million and 1 year later I can only close it at 3 million? It means that I haven't created value in 1 year. So, you know, my investors from the previous round will be pissed, because they will think that they paid a price that it was too high. So that's not a good way to have people, you know, unhappy in your own cap table. But could it be even worse? Maybe the venture capital thinks that my company is worth 2.5 million. So it might be the situation where I need to raise money in the next round at a lower valuation than I managed to do in the previous round. So all my investors will be pissed, and probably they will not even accept and approve my funding round, because they will lose money. So it can backfire once again. So try to find a fair valuation. And once again, fair valuation, you will never go wrong if you ask for this type of orders of magnitude. You know, never ask more than, you know, 15%, between 15% and 25% of your own company, and never ask for too much money. Don't ask for money for 3 years of runway, because that money, the money from the year 2 to year 3, you're paying that money with your own shares at a higher price than you will get it when you grow and your valuation gets bigger, so you will not have to sacrifice so many shares. So just try to find enough, and enough is always between 12 and 24 months. Okay, enough time to reach your objectives and get to the next round. Okay, and once again, you might be thinking, say, I know, but I just want to start a company and just make enough money and have a lifestyle business and make profits, and I don't even want to sell it. I just want to make a lifestyle business. And okay, then this is not the right webinar for you, because if you want to get money from private investors like business angels and venture capital, you need to be aware that they need to multiply the amount they invested times at least 10. So you need to grow exponentially, and they need to do that before the end of the funding terms, of the lifespan of the fund, which is normally around 10 years. First 5 to invest, next 5 to de-invest. So if they invested in you, they will need to recover that money times 10 within the next 5 years. So if you're not willing to grow aggressively, of course, creating a good product with the right team, and I'm not saying grow at any cost, but unless you're willing to play by those rules, just don't go for that type of investment, and maybe just go for other types of investment that are perfectly fine. And there are many companies out there that have been bootstrapped and they just got financed with the money they got from their own clients, and that's fine. And actually life is much easier like that, okay? And now it's much happier, because fundraising is hell. I mean, trust me, as an entrepreneur, I think it's the toughest thing I've ever done in my life. And once again, I've started a few companies, probably more than 10 companies. I've sold a few companies, and I've done a lot of difficult things as an entrepreneur, and the most difficult one is fundraising, because you need to be a fundraiser and you need to be a CEO at the same time, which is very complicated. You need to run your company, to manage and make sure that things go okay or great, to grow, and to look for investors and manage those investors and that funding round. It's really difficult, honestly. Not to be pessimistic, but honestly, it's very complicated. So at least with these guidelines, I hope I can make it easier for you. Also, at the very beginning, you need to value intangible assets. Once again, you're not making money, or the money you're making is ridiculous to value your company at 1 million or 2 million. So, I mean, there are many other intangible assets that justify the fact that you are willing to ask for a 2 million euro valuation, for example. Or just consider WhatsApp. Why did they sell for billions of euros to Facebook? Well, because they were not making money whatsoever. Because they had 900 million users. 900. That's an intangible asset. You can make a lot of money out of those people. And if you don't do it, and if you don't buy it, your competitor will make that money and will get those 900 million users from you. So it's not about the value it has intrinsically, but also the value that it has against your competition, I mean, within the market. And if you consider each user to make an expected amount of, let's say, 20 euros per user in transaction fees, because eventually you can use WhatsApp for micropayments, for example, and micropayments, the lifespan of a user spends whatever, like 3,000, 5,000 euros, and you make 10, 20 euros out of it. Well, then you're making 15 billion euros from that user base, assuming that it's not growing. So consider the value as the intangible assets, the technology behind it. We sold one startup for a bit less than 1 million, and it was not making real money at that point, but we had built a very good product in terms of IT, and therefore we preferred to sell it to a big corporation, and that what they were buying was time. If they could have just built it themselves, but they would have spent 2 years, and they didn't have those 2 years to take the opportunity that we already had taken. So we sold the company because of the intrinsic value of the timing. So don't consider just the financial approach when it comes to startup funding. Okay, that's my take on it. And of course, there's a different risk related to each and every startup. Okay, as you know, there are different types of funding needs. You've seen already the different types of funding stages. The next stage, once you've raised 150k, 200k, 300k to go along for the next 18 months to already find that product market fit, is to scale. That's when you go for growth capital. That's when you go for real money, and that's when you go to venture capital, because otherwise you would need to go to too many business angels to get little amounts of 20k, 50k, 30, 15k, and that you cannot raise 500,000 or 1 million euros. It would be hell. So that's what venture capital is for. But when you go, just be prepared, okay? And that is venture capital goes from, I would say, 500K up to millions, okay? And that, once again, it needs to be because you want to scale to such a great size of your company and eventually be sold or make incredible profits that will be worth it. But normally venture capital they don't like, profits. They like profits. Who doesn't like them? But they don't invest on the startup because of the profits, because they want to close that fund eventually. So it's not worth it for them. They want to maybe sell those shares to another company that will probably like those profits. That's fair enough. But most of the time is because either you go on an IPO, as you can see on the graph, it's an initial public offering, which is because you go to the stock market per se, which is not very common in Spain, for example. That's more for like US companies, or because you actually got acquired by a competitor or a big corporation. That's the most common outcome. So just consider 20. It was bought by Telefónica. They wanted their customer base to start, especially they needed a social network and they needed a small, telephone company for young people, millennials and stuff like that. Or by Beep, they sold to Amazon for, I think it was 60 million. Well, the investors made a lot of money. Privalia also, it was sold for 80 million, I think. TicketBiz, Olapic, another Spanish company, 120 million euros. It was bought by I forgot the name now, a font company, like a design company that found a strategic interest on that company. So basically consider that these startups eventually, if you follow the path of business angels and venture capital, you should have into account that eventually you will need to sell or be acquired or go on IPO. If you want to keep bootstrapping, if you can make it, my recommendation, it's worth it. Because you will not have to deal with so many investors, you will not lose focus on fundraising, you will create value, and the value will be the best KPI of your own financial status, and you will not to be focused on being acquired and multiplying and becoming a super millionaire. That's very unlikely. But what is likely is that you actually do something that you love, that you with the right people, with your own with your own rules, your own terms, your own way, that you grow at your own pace as the market allows you, and make enough money just for you, your people, and in the long term, maybe you can sell it, maybe you don't, but it depends on the scale that you want. Okay, if you want massive scale, massive impact, then just go for funding. Just don't do it for the money, because if you follow the track of going for venture capital and what it takes to like going so huge and being acquired, the statistics says that are completely against you. If you just do it because you feel passionate about it and your ambition is incredibly big and you want to change like a Facebook type of company, then you might need venture capital to take the opportunity to really scale. Okay, just do it for that. If you do it for the money, maybe if you want to just make money but have fun and the impact and the size of the market is not that big, then just keep bootstrapping. Go for other types of financing, finance yourself with your own clients. When you become mature, just go for bank loans and other instruments of credit once you are mature enough so that you can take the risks accordingly to what we discussed. That would be my advice. And in any case, don't forget to enjoy the ride, okay? And I hope you enjoy the ride with us, with me, this sessions, and specifically this one. And if you have any questions, you can see also my Twitter account there, my Emprender Cuesta. So don't forget also Emprender Cuesta. Emprender is hard, it's difficult, and funding is a hard task. But in the end, if I had to give you an advice, like a golden rule of funding, only go for funding when you are so passionate about your company that you truly believe in your company, because investors will smell your fear, your insecurities, and they will, in the end, funding is, as much as we try to make it analytical, in the end it's emotional, even for investors. The best and biggest driver, the most common driver that I've seen in investors is either ambition or FOMO, fear of missing out, fear of being, having an opportunity in front of them and missing it, and missing a great opportunity, or just because they felt emotionally motivated with the impact that they can do. It was Elon Musk that said, the bigger that you have what he called the MTP, the massive transformational purpose. If your massive transformational purpose is big enough, then you will attract probably the right type of investors that they will put their money. Of course, they want to make it with you, but just because they believe in you and the mission that is behind you and your team and your culture and everything. And that to me is the most entrepreneurial approach to funding that I would recommend you, and the one I felt always comfortable with. So in any case, good luck.
So big applause for Alvaro. I think it was a nice talk and really interesting things. In the next few days, we'll send you an email with the link to the webinar and a link to download the webinar if you want to have it in your computer. And thank you. Good afternoon. If you have any questions, as Alvaro said, you can find him on Twitter. And thank you for your time. Thank you for the introduction and for being here today, and also thanks for the team that is behind the camera that make possible these webinars, and to EAE, and of course all of you.